Welcome back to Best Pro for You. Today we are breaking down WTI crudes, which recently just spiked to $85 per barrel, but has since pulled back to around the 81 level, which is currently the very close to the middle Bollinger Band on the daily chart. This, of course, is driven by the ongoing geopolitical standoff over the Strait of Hormuz. A few days ago, as you may remember, oil prices surged by over like 5%. From 75 all the way up to 85, now $10 range or move, as negotiation between the US and Iran hit a brick wall. President Trump introduced new demands, while Iran continues to demand an end to the US naval blockade and sanctions removal before it will actually fully reopen the strategic waterway. So we're talking about 20% of global oil shipments pass through the strait. So this in pace revives supply chain disruption fears and sends prices higher. Furthermore, let's not forget that the US SPR has fallen to its lowest level in over 4 years, which of course is limiting America's ability to artificially suppress the prices. However, the very news that negotiations facilitated by the Oman are progressing, and some of that extreme wartime risk premium is currently unwinding, which causes, of course, WTI to retrace back towards the 81 handle for now. The price, however, and given how the Bollinger Bands are looking, are consolidating, or at least in some sort of manner, they might consolidate, because you've got this contraction, okay, which is between the 70 and the 90 or so, or $20 range. So as long as WTI remains above the middle Bollinger Band, which is very close to currently actually where we trade, the near-term bias remains bullish, and we expect this pullback to eventually resolve higher. However, if this correction is not yet finished and we lose the 81 support, then the door opens for further declines. The first, of course, major downside target would be, let's see, because essentially we're looking at this as a pullback to the leg from 67 all the way up to 93. We'll be looking at the 78.6 Fibonacci around 78, and followed by the Bollinger Band, lower Bollinger Band at 70. Let's not forget that the RSI also remains currently above 50, which indicates that bulls still have a slight advantage on the daily time frame. And given, of course, we've corrected below the 61.8, we can already say that this has been already a deep in this particular retracement. If we look at this as an impulse, there is a potential to actually go all the way up to, it should be around 100 to be fair. Yes, we're looking at 100 if, of course, this leg to the downside has ended. But we're going to see the lower time frames to understand whether this is quite probable or not. And the 4-hour tells us specifically that the recent price action looks like more like some sort of bull flag, right? So given this particular descending channel line, the upper one actually, and that the RSI recently hit 70, and not just hit 70, it did so forming a hidden bearish divergence. We are looking for a potential cooling off, potential further cooling off. We're currently looking at a retest, potentially at the median line down at the around 79 level, which could essentially come at the same time or at the same level where this upper flag line is sitting. So we have to look at the 78 level with interest, if of course this move to the downside continues. If this breakout proves to be false move and we re-enter the channel, okay, that means we go below the Bollinger Band, middle Bollinger Band as well probably, it would open the trapdoor down to 74, okay, and then below that you just had the 73 level, which is the lower Bollinger Band. So if we treat this current move from 75 as another potential impulse with a potential correction coming. The 61.8 also comes around the 78 Fibonacci, the 78 dollars per barrel, and then you've got the 76.50. So we're looking at potential area here of opportunity to go long, okay, if this of course continues. Now, whether that's going to be the 38, the 50, or the 61.8, or the 78.6, this is still not known. But of course, if we remain outside the upper channel and also above the middle Bollinger Band, the more chances that we're going to shoot higher. And if this happened, and depending, of course, on the depth, if we assume the 61.8, this brings us close to 89, okay, which would be, of course, a new multi-month high, because we're making an assumption here, but okay, obviously if we stop here, and then this could bring us up all the way to 92 potentially. But given the strength of this 4-hour candle to the downside, because it's actually an engulfing candle, I think we ought to see further downside. And what is going to help us understand whether this is got a good chances or not? Well, that will be the 1-hour chart. And if we look at the 1-hour chart, the structure becomes a bit more revealing, okay? Following the rise from 74 all the way up to 85 or so, current price action is forming what appears to be, at least for me, which again aligns with 74, what appears to be, actually, let me just get that from here. Head and shoulders, an inverse head and shoulders pattern, with the head being down at 74, okay? And the right shoulder potentially bringing us prices back to 78, 79 area, which would again be the 61.8 Fibonacci, okay, on the 1-hour chart, which of course is also the 4-hour chart. So all of this aligns, all of these signals align for a potential drop short term down to the 61.8 Fibonacci. Crucially, this level, as we said, it's not just it aligns with the 61 Fibonacci trend, but we also talked about this on the 4-hour chart, okay, which creates a technical cluster. So if WTI dips to 78 to form that right shoulder, it represents a highly logical area for buyers to step back in and push for a continuation to the upside. So keep a close eye on the headlines coming out of the Middle East, trade level to level, and watch how price reacts if it tests that 78 pocket.